What's going on, guys, and welcome back to the channel. If you're new around here, my name is Jason, and on this channel you'll find videos on personal finance, investing, and money related topics. And if those are the type of videos that you're interested in, then be sure to hit that subscribe button down below so you don't miss out on future content just like today's video. And speaking of today's video, I'll be going over how to invest your first $500 in Canada. This is kind of a part 2 to a previous video that I did, which was called how to invest your first $1,000 in Canada, which I'll link up above somewhere, so be sure to check that out as well. And with that being said, let's jump right into today's video and go over how you can invest your first $500 in Canada. So I'm going to be covering 5 main steps that you can take. Number 1 is to select an investment account that you'll be using. When it comes to investing, you can choose from a TFSA account or an RRSP account. I recently made a video going over the differences between the two, and I will link that video up above for you to check out. In short, if you're young and you will be needing your money before retirement or for whatever reason, then a TFSA account would best suit your needs. Because with the TFSA account, as your money is growing, your money is actually growing tax-free, meaning when you withdraw it, it'll be tax-free. But you gotta keep in mind, whenever you withdraw your money from a TFSA, your yearly contribution will be reduced. And if you plan on keeping your money and growing it until retirement, then an RRSP account would best suit your needs. And the RSP account is meant for you to use the money that's in your account currently once you retire. And once you do retire and you decide to take out the money, that money is taxed, and that's because when you contribute to an RRSP, you're getting a tax break on your income. And it's very easy to open either the TFSA account or the RRSP account at an online broker or with a robo-advisor. If you're confused on what a robo-advisor is, a robo-advisor most commonly uses mutual funds or ETFs, also known as exchange traded funds, rather than individually picking stocks to build your portfolio. Number 2 is to figure out if you want to do hands-on or hands-off investing, and I'll go over the difference later on in the video. So once you've put your money into your investment account, your next step is to choose if you want to do hands-on or hands-off investing. By this I mean, do you want to do everything yourself, or would you rather have a professional do it for you? Because let's face it, if you're a complete beginner to investing, then there will be a learning curve involved. And in my opinion, if you want to get the best results in growing your money, then you definitely want to learn to invest on your own, which means you'll have to learn the fundamentals and know how to read a financial statement of companies. Because when it comes to robo-advisors, they will just build you a portfolio based on a questionnaire that you fill out, and with robo-advisors you also pay a maintenance fee for the service that they provide. And number 3 kind of ties into number 2, and that's the do-it-yourself method. If you're already familiar with investing, then you can use the DIY route, or you can use your first $500 and use that to learn how to invest yourself. And a good mindset to have is that whatever money you put in, just consider that it's already been lost. And if you're stuck on which company to invest in with your first $500, in my personal opinion, you can do that, but you will only be able to buy very little amounts of stocks per the company. And this way it will take much longer for your investment to grow. Or you can put your first $500 into an exchange traded fund, also known as an ETF. And ETFs are funds that consist of a pool of different companies depending on the index or the different sectors that you look into. In this case, for example, if you decide to put your money into an ETF and one of the companies in that ETF does poorly, that will not affect your initial $500 so dramatically compared to putting your first $500 into an individual company. ETFs also provide you with a great diversification strategy, as these funds have different companies within them. Typically, an ETF is designed to track an index such as the S&P 500, and some online brokers will even have no fees to purchase ETFs. And number 4 is to only invest cash that you won't need within the next 5-10 years. If this $500 that you're putting into the markets for the first time is considered to be your emergency fund, then you might not want to start investing right away, as the longer you invest, the more beneficial it is due to the power of compounding. Because obviously the markets do not go up in a straight line forever, as it tend to have downfalls as well. So some months you will be down on your investment and other months you will be up on your investment. And let's go over a quick example of if you put your first $500 into an ETF, and assuming that the market returns you an average of 6% a year over the 30 years, this will give you about $3,000. Now, this does not seem like a lot, but with the power of compounding, it actually adds up. So let's look at the next example. So let's say you take that same $500 initial deposit that you put into the markets, and then on top of that, you decide to add money every single paycheck that you get. And let's say you put in $200 bi-weekly, and over the course of 30 years, you will end up with about $426,000. And obviously you can put more money into it bi-weekly, weekly, or monthly. That's totally depending on how your situation is. And there's such a big misconception out there that you need tons of money to start investing, and that's really not the case, as I just showed you. In fact, you can start as low as $500 or even lower depending on your situation. And number 5, I'll go over if you really need your cash sooner than 5 or 10 years. So I'll cover some options that you can take while still getting the benefit of investing. Like I mentioned previously, the longer you keep your money invested, the more beneficial it is for you. But of course, our lives are not perfect, and sometimes situations come up where you may need to take the money out. And this is where having a TFSA account comes in handy, as you can withdraw your money at any given time without getting penalized like an RRSP. Another thing that you can do is create a budget of how much money you will put towards investing and how much towards your emergency fund. Also, with your emergency fund, you can have that money sitting in a high interest savings account compared to just a normal savings account, which will not earn you enough interest. And just like that, guys, I hope you enjoyed today's video. And if you got any type of value out of today's video, be sure to hit the like button, as it does help with the YouTube algorithm and it does help support the channel as well. And of course, if you haven't already, be sure to hit the subscribe button down below so you don't miss out on future content just like today. And with that being said, I will see you guys on the next video.